Prices of petrol and even diesel in some parts of the country have touched or crossed 100 rupees per liter. The prices of some very essential food items are going higher and higher by the day. The price rise or inflation is not just a phenomena which is limited to India. There is a surge in commodity prices even elsewhere outside the country. But Professor Ela Patnaik tells us, don't worry, be happy. No, she doesn't say, don't worry, be happy. That's what I am saying. I'm trying to interpret. But she says, don't worry, this is transient. This inflation is temporary, although it touched a record uh, almost 13% on the wholesale price index and crossed the comfort level of 6% for the RBI on the CPI or the consumer price inflation, as we call it. But she says there are 5 reasons for why this is happening, and these 5 reasons also mean we should not be too bothered about it. This will moderate in the coming weeks and months. So we have Professor Ela Patnaik here to explain this to us. I'm YP Rajesh, managing editor at ThePrint. Welcome back. Ela, all yours now. It's very difficult to tell people don't worry about price rise, it'll all be fine.
Yes, it's very difficult. So let's try and understand the data and let's go into detail. Okay. So first of all, the May numbers are above 6%, while the April numbers for CPI inflation were just above 4%. So everybody thinks that there's been a big jump in inflation and that RBI should respond. Now, how reliable is the May inflation number? Last year, in May 2020, surveyors who normally go out to collect data were not able to do so because of the lockdown. So last year, there was a nationwide lockdown, and the data that came was actually one where the RBI also admits that this data is faulty. It's actually a break in the series because this data was kind of imputed, kind of, put together without actually being able to do this regular process that surveyors do, which is go out into the markets and collect the data. In some places, the markets were shut, and in some places, the surveyors couldn't go out. So when a market is shut, how do you give it a price? It's not good data. So that's my first point. So Radhika Pandey and I have written a column primarily arguing why the RBI should not raise rates in response to this higher inflation, because a lot of observers have been talking about how higher inflation for CPI May numbers means that the RBI should or might raise interest rates. So our first point is that this data is not good. The second is that if you look at the WPI data, then actually, if you look at food inflation, food has gone down. Okay, there's been a deflation in food prices in WPI. In CPI, there has been an increase. So like a 1.1% increase in the month of May. Now, two things seem to be happening. First is that usually when WPI declines and CPI increases, that indicates that there are logistical problems. Okay, because the wholesale price index should normally filter through to the consumer price index. Lower prices at the wholesale level should mean lower prices at the retail level. But when does it not happen? Primarily, if their supply chains are broken, if there are local lockdowns, if some shops are shut and only a few are open, and because of local lockdowns across the country, there is this divergence between food price inflation in WPI and food price inflation in CPI. So we expect that the WPI lower prices will actually pass through, will also be seen in the CPI prices, perhaps with a lag, maybe, in June or July, as often happens that when WPI prices are lower, when wholesale prices are lower, then retail prices also become lower. A third reason, now, since you've asked me almost to explain the whole, I'm going on in a monologue, but Yeah. So the third
No, I'll
reason,
interrupt you when you
yeah,
come to my
yeah,
favorite topic.
yeah, feel free to interrupt me. The third reason is that, look at this near 12+% increase in WPI is on a base when last year there was a contraction of more than 3%. So when prices normally, go up a little, but prices had actually gone down. And so when you compare that, or what we often call the base effect, that they hadn't gone up or even stayed where they had been in 2019. Compared to 2019, wholesale prices in 2020 were lower. And now we are comparing ourselves to 2020 when they are lower. So we are seeing a big jump. So this thing of that the WPI inflation is 12% and it's going to go into CPI and food is higher in CPI. I mean, there's a disconnect. Let's first try to understand that this is not regular data before, because of the lockdown, then because of the logistical problems now, and then of course we expect that these trends which are we are already seeing in the WPI of lower food price data, with the monsoon, with the better monsoon, they will also go away further. So that's really the reason to believe.
Data on one side, Ela, I mean, obviously, economists will depend on data and quote the data and the numbers. But how do you explain fuel prices being what they are? Because uh, it's like one of that kind of a emotional milestone, 100 rupees, that petrol or diesel has crossed 100 rupees in some cities, and it will pinch the pockets of people because that's the basic fuel we use. And now that the lockdowns have been lifted, now people are going out, going about, going to work, using their cars and scooters and bikes. So it will pinch. And whatever you might say, there is a global, oil price going up. It is 72, $75 a barrel. But the government in India has not been cutting the taxes on petrol and diesel. How do you explain that?
So absolutely, I think that the fiscal dependence on fuel taxes kept increasing because when fuel prices went down, they raised taxes, so
Mhm.
that the retail price for the consumer appeared not to change, even though global prices had gone down. So now, when global prices start going up, by now you're too dependent on fuel taxes, so you're unable to cut those taxes. I mean, already you're hitting 9 to 10% of a fiscal deficit, and this is the time when with the pickup in the US economy and global trade, global fuel prices, oil prices, if they start rising, you've got yourself in a bit of a bind, because you for cutting prices, for controlling inflation, in principle, you should be cutting fuel prices, because after all, you had raised taxes. Sorry, you should be cutting fuel taxes, which will give rise to lower fuel prices, petrol prices, because you had raised them saying that, oh, look, the retail price hasn't changed. So, which means that if you were planning to keep the retail price the same, then you should have accordingly cut taxes. But it's very difficult for the government to do that, given the high dependence on fuel taxes now. All these years you kind of got addicted to taxes on petrol and diesel, and you certainly can't get rid of them at a time that's as bad as now. So I think it's a bit of a tricky situation now.
Mhm, mhm. And this whole tricky situation, Ela, as you call it, has led to also this dilemma, which is, has been a long-running dilemma between inflation and growth for, the RBI. And should we raise rates? Should we hold rates? We should, push growth, or should we tackle inflation? And earlier this week, there was a very interesting piece, on Bloomberg. I don't know if you saw it. We published it on ThePrint, which said that India and Brazil are trying to tackle inflation exactly the opposite way. Brazil has raised rates to clamp down on inflation, and we are not raising rates. We are saying, let us take a risk with inflation. Let's see how far it goes, because we need to push growth. Which side of the argument are you on here?
Yeah, so I think we are doing the right thing. And for once, I agree with what RBI is doing. That you know, RBI's mandate is to target inflation, but being mindful of growth. The time to raise rates is when inflation is pushed by higher demand. If there's overheating of the economy, then you
Mm,
start raising rates so that you cool the economy down. I mean, this
mhm,
is hardly, I mean, the economy is still, it's been in a contraction for a year. It still has to come out of the second impact of the second wave. This is not a time when you want to start raising interest rates because you'll push the economy down. We also understand very clearly, at least in India. So I've read the Bloomberg article, but I don't know. I haven't fully read all the monetary policy committee meetings of the Central Bank of Brazil and understood what they are thinking. But at
mhm,
least for our monetary policy committee, I think it should be clear that there are supply side constraints. There are supply side issues. So, for example, what's also gone up in terms of prices is edible oils and pulses. Now, the
mhm,
government has a stock of pulses. It can release that stock of release pulses. It can reduce import duties on edible oil. It can reduce import duties, as we just discussed, on fuel. So
mhm,
you have sort of like many instruments in your hands before you start raising rates, because that is going to impact GDP growth, investment as well. This is
mhm,
not a time. I mean, you're giving a moratorium on one hand. Until yesterday, you're saying that people needn't pay interest, and then tomorrow you turn around and say, oh, they have to pay higher interest.
mhm,
So I think for the Indian economy at this stage, we have supply side instruments. We have taxes that have been imposed and can be cut. So we should be trying to employ all those rather than at this stage try to fight this inflation with higher monetary policy. Also, monetary policy has a 1 to 2 year time horizon. And I would just say wait and watch for some of these supply constraints to be eased, try other methods, and only if you see a general demand led push in inflation should monetary policy be used as an instrument to try to control that. And that
mhm.
stage has not come yet. So we should not be doing that.
I have one last question, Ela, before we go and take questions from a lot of our viewers who are already sending their questions on Twitter and other social media. Is the global situation? Demand is returning in other parts of the world, and especially in the US and Europe. So oil prices, commodity prices are going up, and that will not help India. So how do we deal with that headwind?
So we do have a couple of instruments in our hands to fight global inflation, imported inflation, as I may call
Mhm,
it, when global inflation goes up. One is that if there is an inflow of capital, then instead of buying up reserves as the RBI has been doing, you allow the currency to appreciate. Okay. So when you allow the currency to appreciate, then anything that you're buying becomes importing becomes cheaper for you. Okay. And wherever demand is inelastic. So for example, demand inelastic means that you're going to buy that much oil regardless, of the price. So you then just want to think about how you can reduce the price. And one way is appreciation. Similarly, a second instrument you have in your hands is is tariff cuts, import duty cuts. Now, I'm not saying that trade policy should normally, under normal circumstances, be used for inflation control. No, trade policy should be determined by trade policy. But these are very unusual circumstances. And in these very unusual circumstances, before you think about raising rates, so it really requires a coordination between the Reserve Bank of India and the Ministry of Finance and the government, that they think about this as a situation that they have to handle together. And the government, instead of saying, oh, we'll continue to do whatever we were doing, but when RBI raises rates, we are going to crib, as governments always do. Instead of that, there could be a coordinated mechanism of trying to. So RBI could allow the currency to appreciate, government could cut tariffs. So to some extent, you would, and as we just discussed, reduce duties on edible oils or fuel. then you can kind of manage this bout of sharp increase in prices and allow growth to pick up rather than put the brakes on growth by raising rates now. That I think is very dangerous.
Ila, we'll go take some questions. We have a lot of viewers who are sending us their questions on social media. And before I take the first question, this is the time for when, in the show, I make my appeal. Very simple. You should take a subscription to the print. And why? Because if you want some clear and honest insights like the one Professor Patnaik brings to you, you need to encourage such digital media companies. So please take a subscription. Go to theprint.in/subscribe, or the link will be below this video after we finish this segment. Please do subscribe. We need your support and your contributions to make the print grow. Prangan AO says the inflation is maximum, but it is shown only as 5 to 6%. Is it manipulated? Who calculates the inflation data in India?
No, actually, I've looked at inflation data, and if you are actually interested in deeper analysis, then there's a paper that I have with some of my co-authors from an IPFP where we've looked at data from various sources and looked at inflation numbers. So, for example, various commodity markets, you track those series and you look at the rate of growth of prices. So the CPI data is actually reasonably good. Okay. It is not manipulated. And while I'm just asserting this here, I would encourage you to go and look at the evidence for this in terms of tracking data from different sources and then looking at the CPI, and you'll find that the CPI is actually a pretty good measure. When you say inflation is maximum, well, inflation is can be higher. In many historical time periods, it has been higher. So currently, if it is 6%, it means that compared to this month last year, the weighted average consumption basket is now costs you 6% more. Even though at this time, as we said in the beginning of the program, there are difficulties in collecting the data because many markets are shut. And if a market is shut, then what is the price? So you kind of try to interpolate the price, and then you try to, come up with a number. So it's not perfect data because of the lockdown, but otherwise it's reasonably reliable data.
Mm-hmm. There is a question on Twitter, but there is no username. For some reason. The question, Ila, is would lowering taxes on petrol or diesel by 20 to 30% help boost consumption and GDP now that the lockdowns have been lifted? We referred to it when we were discussing this, but will lowering it help boost consumption?
Well, it puts money back in the hands of people, and if people spend, it does. But if people don't spend, so, if the money goes to those who are currently, salaried, who are not spending, then the multiplier would actually, if it goes into savings, then it would lower the multiplier. Whereas if the government collects it as taxes, so, I'm not making a judgment on, I'm not saying that it should stay as taxes, because that we've already argued is not good for price rise. But I'm just saying that if you look at the multiplier, then if you push that tax into the hands of those whose marginal propensity to save is high and their marginal propensity to consume is low, if it goes to that strata of households, then it is not necessary that it will increase consumption. So if it goes to people with lower population, then it could be neutral, that it gets spent as government spending when it goes into the hands of the government, and it gets spent if they have, let's say, a marginal propensity to consume of 1. That is, they consume every additional rupee of income that comes into their hands. If they do that, then the impact on consumption is the same. Otherwise, it's not.
So people have to spend. It's not a question of putting money in the pockets of people.
In fact, what you're finding lately is an increase in cash holdings. So currency with the public has increased. You're also finding an increase in bank deposits. So people are not spending as much.
I think there is an insecurity or fear or uncertainty which is probably holding people back from spending, or that is what one comes to see and read.
Right. I think it's more than that. So, one, there is uncertainty. The second, a lot of markets are shut. People are
Mhm.
not also, happy traveling, going out,
Mhm.
spending money. Normally in summer at this time, a lot of people would be traveling because it's school holidays for children,
Mhm.
and
Mhm.
people would take vacations and they would go out. But that's not happening because of the lockdown, because of COVID, because the second wave has been so deadly that people have been ill. And
Yeah.
this is, you spend on health. Yes, expenditure on health has increased, but it's not that all other spending increases. So you're actually finding
Yeah.
more savings, more household
Yeah.
financial
Yeah.
savings because of the skewed income distribution.
Yeah.
So the poorest spend everything they earn, while the salaried and the better off, they are the ones whose financial
Hmm.
savings are increasing.
Yeah. Where do you go and spend? That's the question. Uh, Nikesh Gupta, thank you, Nikesh, for your question. With the amount of US dollars being printed since the last year, what impact or how will this affect inflation in India?
So I think if there's a lot of liquidity in the market, then I think, as he seems to be correctly understanding, if you if that money comes into India, then we can have two responses. One can be that we uh, uh, let the rupee appreciate. Okay, because if there's a lot of money being printed in the US, there's liquidity sloshing around in the global financial system, and some of it comes to emerging markets, including to India. Then one response that we can have is to allow the rupee to appreciate. If
Mhm.
we allow the rupee to appreciate, then we don't get inflation because it keeps, it at least keeps imported prices low. Uh, Prices of those goods that we import, they remain low, and a lot of inputs that we import remain low. The second response that we could possibly have is we could say, oh, we're going to buy up all those dollars because we, for some reason, wish to focus on exchange rate management and not on inflation control. If we start buying those dollars and just expanding the balance sheet of the central bank by forex intervention, so the RBI holds more and more forex reserves, then it increases liquidity in the system, and that increase in liquidity in the system actually impacts inflation adversely. Now, alternately, if the RBI chooses to then step in and sterilize its intervention, then to some extent it can counter the effect of that increase in liquidity. And so then it's not an inflationary. So
Mhm.
that's I think that's really what would happen depending on the policy you choose, which of these three things you do. That makes that determines what is the impact of US money printing is on domestic inflation in
Mhm.
India.
Mhm. There is a radical suggestion slash question, Ila. He says, "This is I'm watching this one, the YouTube comment section, chat section. This is Raju S. He says, should the government waive 2 months of EMIs and rents for everyone? Will that help consumption?
So, will that help what?
I mean, it'll put more money in all our pockets if we don't have to pay 2 months of EMI or rents.
Yeah, but somebody is receiving the EMI also. So, suppose the bank depositors are told that you will not receive income for 2 months because the ones who are asked to pay EMI are not paying EMI for
Mhm.
2 months. Then it's really a distribution of income,
Mhm.
right? Similarly, for rent, if the landlord is told that your income is going to go down by 10,000 rupees because your tenant is not going to pay, then it is basically a redistribution of income. So, again, the impact depends on who consumes more and who saves more. So, if the person from whom income has gone away was spending the entire amount, and the income to whom it has gone was saving, then it can actually reduce consumption. But it is these answers which are about redistribution of income
Mhm.
are actually, overall, I would say, net the effect of such redistribution is not very high. net, because when you're taking money away from one person and giving it to the other. So obviously, when you're stopping EMI, you're stopping interest rates. Unless you assume that you just stop EMI and then there's some manna from heaven that comes in and keeps paying interest to the depositors.
Mhm.
Now, that we can't afford to do. So, it's just a question of redistribution. That's not
Uh,
going to help much.
that's not going to help. Ranjit is asking us, with the Make in India initiative, do you think it will largely help in curbing inflation? Because at least import inflation, like you mentioned.
Well, Make in India initiative is about investment and production in India. So sometimes it can help and sometimes it cannot help. Now, think about a Make in India initiative that says that if you have cheap imports available, say East Asian imports, Chinese imports, okay? So if I can buy an AC for 40,000, instead, because there's a Make in India initiative, we could possibly be imposing an import duty on it of say 25% or a ban or something. I mean, I'm just saying protectionist measures. You can
Mhm.
think of protectionist measures. When you put those measures, then the price for the domestic consumer of that product would increase by the amount of additional tariff that you have imposed. Domestic industry might take some time and hopefully will later produce cheaper products, but immediately the impact is usually to raise domestic prices. The total price becomes the price at which it was imported plus the additional tariff. That's the short term effect. Now in the long term, if you are able to somehow ease that protection after a while, not actually let it persist for very long, and somehow domestic industry becomes competitive, and then it starts producing and it produces more cheaply than what was the imported price of the product, then you can have a positive impact on inflation. And that too, inflation is a persistent rise in prices, not a one time effect. So, before you jump from the Make in India to inflation, I would say try and think through the steps, think through the mechanism through which Make in India will work. If it works through protectionism, then what kind of an impact can it have on inflation? And that, as I say, in the short run, certainly not one that would lower inflation.
I think we have time for one last question. Ila. There are quite a few questions coming, but we've already been at it for nearly half an hour. Uh, RBI has never used monetary policy to a large extent as a tool to counter contractions. This is what Sankalp is saying. It is mostly fiscal policy exercised by the government of India. Is it because RBI is dominated by Keynesians, or rather a lack of monetarists? This is straight out of some economic textbook, Ila.
RBI is dominated by what?
Monetarists.
No, what was the first one? Either
Is it because RBI is dominated by Keynesians,
Keynesians or monetarists.
or rather a lack of monetarists?
No. I think you go back and look at how the repo rate has been cut consistently for the last 4 years. I mean, either it is unchanged or it has been cut. We've not seen a hike in repo rates for the last 3.5 years or so. So, if you are thinking that RBI has not used monetary policy to counter the slowdown, I don't think that's entirely correct. I think that what's been happening with these cuts in repo rates have been to, and if you must be reading monetary policy committee statements, which are constantly saying that, inflation, investment is sluggish, we are worried about growth, and inflation is within control, and then they cut the repo rate. So it's been very much in place, in use for countering a slowdown. And we don't get contractions, incidentally. So contraction was just last year. Normally, emerging economy business cycles are about deceleration or a slowdown in the growth rate and not about a contraction. So just to correct you on that, other than last year, which was a very abnormal year.
Okay, last question from me, Ila. Do you think CPI will come below 6 by the time the monsoons end in September, October, and we're getting into the festival season, October, November? Or do you see that staying around the 6 percentage level for a while?
So YP, I think that it can come down below 6, but then the government does need to take some measures. So edible oils, pulses, and fuel prices. On these three, the measures that we've outlined in the column this week, government does need to take some measures, because while we are saying that it's not a demand side thing and it won't persist, but we're also saying that for this, supply side measures do need to be taken, and then it can stay below 6, come down and stay below 6.
Edible oils, pulses, and fuel prices. Let's hope we see some action from the government on this front in the next coming weeks and weeks more than months rather than months. We will be back, but next week, next Friday, same time, with another live edition of Economics. Professor Ila Patnaik will bring her insights into what could be the next big issue on the economic policy, macroeconomy front next week. Please do come back and log in and watch us. Thank you so much for being with us this week.